Hey everyone, me Kevin here. Oh boy, the Federal Reserve minutes are out. We just went through almost absolutely every single line in the report, and I don't understand. Apparently some people are trying to allege the market's turning slightly green because the report wasn't as bad as it could have been, and that this report is somehow evidence of a Fed pivot. And I'm thinking to myself, what the hell are you smoking? This report actually had a very bad pivot to the bad side in it. And we need to talk about that pivot because it is the greatest risk to our economy. And this is not even just FUD. This is just like straight up potentially bad. We're going to talk about what that issue is. And they gave us a pivot to the dark side on that issue. So we have to pay specific attention to that issue. But what we're going to do is we're going to go through the report and I'm just going to show you the highlights. So let's do it. The first thing that we're noticing is liquidity is falling in the Treasury market. So this is not great because this is the same sort of disaster that is happening in the United Kingdom. The United Kingdom does not have enough buyers of bonds. When you don't have enough buyers for bonds, price go down. And prices have been going down so freaking much in the United Kingdom for bonds that their Federal Reserve, known as the Bank of England, not to be confused with banks like in America, had to come in and set a floor. And that floor goes away Friday. They're like, yeah, we're removing the floor. So don't tell us we rug pulled you. So prices could then continue to fall. And they did so because pension funds were about to go bankrupt. And then millions of retired people in the United Kingdom would have been screwed without their pensions. It could have been a disaster. So anyway, the same kind of liquidity issues that we're seeing in the United Kingdom are now actually being remarked on by the Federal Reserve. That's not good. That is a lack of liquidity in the Treasury markets because of elevated interest rate uncertainty. This is how things break. They talk about this potential that the reverse repo markets will get used less. That's not actually happening. So the reverse repo markets are when banks park excess cash overnight, and the use of those markets is exploding. We're like $2.3 billion. It's absolute $1 trillion. I'm sorry. It's an insane number. I'll show you the chart right here. And so we're not actually seeing a decline here, which the Fed is hoping to see a decline here so they could actually see that their policies are starting to work, but they're not yet. It's still not working. So what the Fed's doing is still not really having an impact. Now, throughout this report, they must have mentioned about 20 different times that the labor market is still very, very tight and strong. And this is actually a really bad thing because at the same time as you have the labor market super tight, you have a broadening of inflationary pressures. Now, what's very important to remember about that specifically is that wages and inflation, hold on, let me find the section. Here it is. The Fed tells us that what's probably going to happen first is you're going to see demand fall and then inflation go down. But this creates a really kind of perverse trajectory. Follow along with this for a moment. The Fed says, the Fed noted also that inflation had not yet responded to policy tightening and that a significant reduction in inflation would likely lag that of aggregate demand and that we'd probably need some softening in labor market conditions to actually get there. So think about what that means practically for a moment. That means in order to get inflation down, waiting doesn't work anymore. We actually have to see demand destruction. So demand has to go down, right? Big old down. Then after we see demand go down, we have to see that softness in labor. And only after that, and with a lag, do we actually get inflation down. So that kind of sucks because it tells us that, hey, look, we're going to probably have to suffer under the weight of high rates and bad earnings for longer because we have to get through the pain of bad earnings in order to have labor go down, which will then drive inflation down. So it's kind of just going to be a sucky process. In fact, in this report, the Fed talks about how it's probably going to take the, quote, coming years to actually get inflation down. I don't know how anybody read this and was optimistic about it. It wasn't actually good. In fact, we're starting to see, according to the Federal Reserve, credit card and auto credit delinquency rates rising over the second quarter. So in the third quarter, they rose over the second quarter. This, by the way, right here. So in addition to this little kind of path that I just drew for you, which is, let's go back to it for a moment. Demand has to go down. That hurts earnings. Then you see softness in labor. Then inflation goes down. That order is really terrible because in the meantime, if we get wages that continue to go up, so wages continue to go up, which encourages people to switch jobs, because if you switch jobs, you tend to get about twice the wage increase than if you stayed at your job. Quick explanation of that. That would mean if you made $100,000 a year, if you stayed at your job, maybe after 1 year, you'd be at about 107.4, which is about a 7.4% hike. But if you switch jobs, you might be at about 114.9, which is almost twice as much more additional pay if you just switch jobs, right? This is what the Fed is trying to prevent because it creates something really, really nasty known as a wage price spiral. Now, a wage price spiral is the absolute worst thing that could happen to the economy and could literally lead to an economic collapse. The dollar could collapse, the United States government collapse. And I'm not being overbearing here. Like literally, the Fed will do whatever they need to do to prevent a wage price spiral, and they won't let this really take hold because they know how bad it will be. Like you'll get Weimar Republic, you'll get Venezuela, you'll get all that if you get a wage price spiral. And so they have to kill this. Wage price spiral is where wages generally go up more than the rate of inflation. So let's say if wages are going up by 6% right now and inflation is, let's just say 5.9%, in a few months it drops to 5.9, but now wages are higher, you technically have a spiral where wages are going up, then product costs go up because people have more money to pay for those things. So then you get product costs or people raise prices for products, then those wages aren't as valuable anymore. So people demand higher wages again to be able to afford those products. And you continue to get this stair climbing, which ends up looking kind of like a spiral. It's really, really bad. So what was really devastating was actually the difference. This is the pivot, okay? This was the pivot. The only pivot I saw from the Federal Reserve was the following, okay? It's on page 8 of the last last minutes from July. So from July 26th and 27th, on page 8, the Federal Reserve said the following. They said, in addition to the committee's ongoing policy firming and anchored longer-term inflation expectations, these included competitive pressures restraining prices, the apparent absence of a wage price spiral, the tightening of monetary policy, blah, 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 blah. Look at those words. This is the only time wage price spiral was mentioned in the last minutes. The apparent absence of a wage price spiral. That was last time. Look at what they said this time, folks. It's terrible. Okay, ready for this? It's right here. It's on page 6. The staff, is it here? Hold on. Maybe it's not actually on page 6. Hold on one second. Sorry. It's also on page 8. It's right here. Ready for this? A number of participants commented that a wage price spiral had not yet developed, but cited its possible emergence as a risk. That's very different from the last report where they said no wage price spiral. Now they're like, we might be at the start of a wage price spiral. That is how you collapse an economy. That is how you absolutely destroy an economy if you let a wage price spiral happen. This is terrible. Like, that's actually really, really bad. So, they believe that the economy will be suffering from below trend growth in the coming years as they fight inflation down. They want to remind you to take advantage of the coupons on building your wealth for those programs before Friday at 11:59 p.m. because lifetime access will be getting stripped for anybody who buys, especially the Path to Wealth course after Friday at 11:59 p.m. So if you just want to guarantee you have lifetime access to the live streams and the courses, like new lectures that are added to the programs on building your wealth, just get in before Friday at 11:59 p.m. Then they also want to remind us that they're not seeing any kind of broad-based inflation yet. If anything, we're actually still, or deflation yet, I should say, we're actually still seeing some businesses that are like, oh, we're having some relief in supply bottlenecks. But then other businesses are like, no, we're actually not having any relief. So even though we're starting to see some commodity prices fall, not every business is actually benefiting from commodity prices going down. Some businesses are like, what are you talking about? Like, inflation is still actually going up. So that's bad. We need like all businesses out there shouting like, oh my gosh, everything's getting a lot cheaper. We're not seeing that yet. At the same time, you're getting higher financing costs, which is slowing down investment, like fixed investment from businesses. And manufacturing is slowing down, which makes sense because inventory is piling up like crazy. Lower income individuals are getting screwed, but higher income individuals are still spending. They're actually holding up quite well. They don't believe the recession is real. So the Fed's like, all right, well, let's screw them. Let's start with their stocks, then we'll go on to their real estate, and then we'll just show up at their house and kill them. Okay, no, I'm just kidding. now I'm gonna get banned off YouTube. That was a joke. Anyway, participants expected the transition towards a softer labor market would be accompanied by an increase in the unemployment rate. Last SEP, they estimated that the unemployment rate would go up to about 4.1%. It's kind of a nominal increase, honestly. They also talk about how some businesses won't actually lay people off because they're so jaded by how hard it's been to actually hire people. Weaker consumer demand would result in a reduction of business profit margins from their current levels. They're giving you an earnings warning right here. Businesses are planning to cut prices. They talk over here about how pivoting too soon is actually bad because, like, even though current shorter-term inflation expectations are anchored, longer-term inflation expectations are not, and they're actually pretty diverse. And so that's a risk that if you pivot too soon, you could end up destroying inflation expectations, then inflation starts going back up, and then you're really screwed. So whoever's saying the Fed is indicating a pivot here is just smoke and crack. In my opinion, the slowdown in Europe, this is the only time they mentioned the word recession was actually about Europe, recession in Europe right here. I don't think the slowdown in Europe's going to be over until at least 2023. Probably, I mean, like, their winter's going to suck. I mean, Paris is already turning off lights to, like, the Eiffel Tower and stuff to save energy. This could hurt real estate rates more, the sale of mortgage-backed securities. Keep in mind that treasuries are rolled off, mortgage-backed securities are sold. So rolling off just means they're not buying them again, right? Because they're shorter term. Mortgage-backed securities are like 30-year bonds. They're likely going to get sold at a loss. More of them being available lowers the price of those mortgage-backed securities, which are a type of bond, which leads to higher yields on mortgage-backed securities, potentially driving up mortgage rates. Bad for real estate prices. Good for HouseHack. Which, remember, if you're an accredited investor, go check out househack.com and get yourself founder shares. No upfront dilution. You are buying shares at the same price I'm buying them for. $1 equals $1. We're basically selling shares of the company at net asset value is what we're doing. Some people are like, well, just call it that. And we're like, okay, yeah, I mean, that's a fair way to put it. But anyway, this isn't a solicitation. Get all the details on the PPM over there at househack.com. Okay, so we talked about the trajectory of inflation going down. There was some pushback that, we have to be careful that, and this is potentially where some people are getting this idea of like a pivot from, that they have to start considering the downside risks of tightening too much. But keep this in mind, the wage price spiral is worse and more important than that consideration, in my opinion. And so I think even though this will be a concern, it doesn't imply a pivot at all. And that's it. So there you have it. That is a summary of the Federal Reserve's minutes. Thank you so much for watching. Make sure to subscribe for more of this content. And remember that tomorrow at 5:30 a.m., the CPI report will be coming out. Delta Airlines also reports tomorrow, says Blau. That'll be really interesting. The summer travel season, I think, was very great. American Airlines already preliminarily guided higher on both revenue and margin, but still like down 9% from 2019. Yeah, Fed already said the risks of doing too little outweigh the risks of doing too much. Exactly. New supply squeeze on gasoline from OPEC feels like they just want the world to burn. Well, I mean, you have to remember, these oil companies, they really got screwed during the pandemic, and they shut a lot of wells, and they fired and laid off a lot of people. Now, like, you look at oil kind of like this. Okay, watch this. Wells, not Wells Fargo, okay? Oil wells went from like that to like that because of COVID, and it's come back really slowly. The reason for that is a lot of these companies have had to take on a lot of debt just to stay alive during this period of time, and it's also hard to hire like new oil workers, right? Deck workers, engineers, whatever. So I'm not here to sympathize with the oil companies, okay? I'm just saying, like, they're going to do whatever they can to milk high energy prices as freaking long as possible. And they're going to use that to pay down their debt and hopefully continue to open more wells. But anyway, that's just my thesis on oil. So like, from a capitalistic point of view, I don't think you can argue that, you know, the oil companies are wrong to cut supply. I think from a social point of view, they're total jerks. But not from, you know, from a capitalist point of view, it makes sense. You know, capitalism isn't nice. Okay, CPI tomorrow. Thanks so much for being here. We'll see you soon. Goodbye.